MBA ASAP. MBA ASAP.
The nice thing about this is financial statements, right? And I think that is a part of business that tends to be intimidating to a lot of people just because it's the numbers and it's all of these buzzwords around it and it's relatively technical and what does it mean, and so we tend to shy away from it. And so what this whole course is going to be over the next 2 weeks is just to dispel all of that mystery, and you'll understand that it's really not that complicated at all. And for the most part, you already know these things, and you just don't know maybe some of the formats and stuff. And it's a great thing to know for any business that you're looking at, any business that you're involved in. That's how you see if the business is doing well or not, is with financials. Now, one thing I'll talk about is in the United States, we have one set of rules for preparing financial statements, and the rest of the world has another set of rules for preparing, right? Always that way. Just like everybody else is on metric, and we have feet and inches and miles and stuff, right? And pounds and all these crazy ounces. Same thing with financial statements. And there's been efforts over the last couple of decades to try to harmonize those rules so that it would be one set of rules for the whole world, because international companies have to prepare two sets of financial statements. You have to prepare one for the United States and one for the rest of the world, especially if you want to be on a U.S. stock exchange, which are really the most vibrant stock exchanges, are the New York Stock Exchange and NASDAQ, and also a lot of companies like Alibaba, right, the big, giant Amazon equivalent from China, wanted to float their stock on the New York Stock Exchange because it's a really good exchange. It's been around for a long time. Everybody knows how it works, and it works pretty well, except when it doesn't, like in 2008 or something. So that's sort of the preamble to this. The math is not hard. The math, it's basically addition and subtraction. And when it gets really complicated, there might be some multiplication and division. But that's really the complete, end of it. So financial statements are basically the product of accounting. That's what accounting actually makes, is financial statements. And there's 3 financial statements. And can anybody know what they are?
Balance sheet.
Balance sheet. I'm just going to put BS, but don't take that. Income statement. Cash flow statement. And I'm going to write them up here like this because this is how they fit together. A lot of times when you see financial statements, they're just static documents just on a page, right? And you see an income statement, you see a balance sheet, and then you see this squirrely thing called a cash flow statement that, nobody knows what it does, right? And but they actually interconnect and flow, and that's what we're really going to talk about. Once you understand that, then you really understand what's going on with financial statements. So these are this. It's just three things you have to remember: balance sheet, income statement, and cash flow statement. Let's start with the income statement. It's the one that's probably most familiar to all of us, right? And what it is revenues minus expenses equals net income, right? So it's what you do every month, right? You get your revenues are the money you get from your check or whatever it is that you get your money from, and then your expenses are everything you have to pay, your rent and your car payment and your food and clothes and everything else. And then hopefully hopefully the expenses aren't more than the revenue, right? And what's left over is called net income. And it's also called other things too, right? It's called profit. It can be called profit. And it's also called earnings, right? So profit, earnings, net income, these are all synonyms. They all mean the same thing. They're what they, and we've all heard the phrase bottom line, right? The bottom line is this or that. That phrase, the bottom line, came from this. That's the bottom line. It's after your revenues. This is considered the top line sometimes. I never heard this called the middle line, but you know. And in an income statement for a company, even for our own selves, right? This might be one line revenues, right? It might be just your check, your paycheck. Or it might be that you get money from a number of different sources. In a company, you want to have a robust revenue stream where you have lots of different revenue streams. You might have a service, service contracts, and then product purchases, all different kinds of things, all different lines that make up this revenue stream. Because you don't want to, the worst kind of, the riskiest kind of company is where you have, say, one big client, right? Say if you're a consulting firm, you have a consulting business and you have just one client you work for. Well, if the person who's your contact there retires and then somebody else comes in and maybe they don't want to necessarily work with you, there's so many risks of how you could lose that business, right? But if you have hundreds and hundreds of customers or something, then you have a more robust, if you lose one or two customers, it doesn't really matter. You have lots of them, right? Or you can gain them too. And so it's you can look at the health of a company by the structure of its revenue stream. That's one thing you can look at, is how many different sources of revenue does a company have, and are their sales really chunky, or are they smaller sales where they're making lots of them? Any questions about
public usually?
Public?
Yeah.
Information?
Yeah.
Well, that's a good point. These financial statements are reported by public companies, and when we say public companies, we mean companies that are traded on the stock market. Any company that's traded on the stock market it's required by the Securities and Exchange Commission to report every year audited financials, and by audited financials we mean financials that have been reviewed and scrutinized by a CPA firm, certified public accountants, and then they opine on those and say that these financial statements have been produced in accordance with GAAP, which is the rules that we have here. GAAP is GAAP, and that means generally accepted accounting principles. And those are the set of rules that the accounting board, FASB, the Financial Accounting Society Board or something, has come up with so that everybody does these the same way, right? You have to have a set of rules so that you know that these financial statements are prepared in a similar fashion, so that you can compare Microsoft's to Apple's to General Motors to Ford, all these different companies. Yeah, so companies that are public have to do that, and they have to disclose their financials. But private companies do not have to do that. So private companies don't have to produce financials and don't have to disclose them to anybody. If private companies have investors or bankers or anything like that, those people also want to review the financial statements. So when you talk about the users of who consumes financial statements, who uses them, investors, credit analysts at banks. Banks, when they make a decision, are we going to lend to this company? They're going to want to look at financial statements to see, is this company going to be able to pay us back what we lend to them? And so the way they do that is to look at the financial statements. And they want to have these financial statements done by GAAP or whatever, the IFRS. And that's the International Financial Reporting Standards. So those are the international ones. So you want to have your financials done under those type of rules, and then you want to have an outside party review them and say, yes, stamp of approval, these in fact have been done by these kind of rules. So public companies have to do these. Private companies don't have to disclose them. Private companies need to make financial statements for any of their outside investors or outside banking relationships, or even for tax purposes and things. You have to show and prove what your, how much money you made, so they know how much you're paying taxes on and all. So there's a bunch of outside entities that look at financials. And then there's the internal. The management wants to always look at, and management a lot of times they'll make non-GAAP financials because they don't have to go through all the extra kind of reporting things to transparency, so that management can see how we're doing on a daily or weekly kind of basis. So there's internal people that look at financials, and then there's the outside people that look at financials. And the SEC is the group that oversees the regulatory rules in the United States, the Securities and Exchange Commission. And the Securities and Exchange Commission was formed in 1933 and 1934. There was
I thought it stood for Southeastern Conference.
It stands for that too. If you're, yeah, and that's the more important one. Is that for football and basketball?
Yeah. She probably knows the SEC.
And who's number one, right? Bama again, aren't they?
Alabama's always,
Number one
several
nowadays.
years running.
Yeah. Wow.
They've turned into
Powerhouse.
They've turned into a pro team.
I think they're like an NFL team.
They are. Well, they're an MFL farm team. Yeah. But amazing. Yeah. And right. So the SEC does mean that, but it also means the Securities and Exchange Commission, and that was made after we had a stock market crash in 1929 that was really bad. And when the stocks were, there was all of basically the stock market really works on psychology. So when everybody's really super enthused about stocks and they're making money, they pour more money into it and they think it's going to go higher and higher, and then it goes higher and it makes what they call a speculative bubble, right? That ultimately pops. Just like there was a tulip frenzy in Holland in the 1600s, where tulip bulbs were traded like crazy and went up to fantastic amounts of money. And then suddenly people realized, wait a minute, this is a tulip bulb, and it had no real intrinsic value other than the speculation, and that whole market collapsed. There's been these boom and busts of speculation all the time. So what happened then was everybody, and back in those days, there was no reporting of companies. It was all just like, I got a tip from somebody, and this is going to be a hot company, it's new railroad stock, and people would put money into it, and a lot of times it was fraud. And so finally, the stock market collapsed. And when that collapsed, a lot of and we'll look at it, the asset side of the balance sheets of a lot of banks were holding these stocks. Their asset values went down, their liabilities didn't, so their equity went away, and suddenly they were bankrupt. And so all these banks started to fail. And then people panicked and thought, oh my gosh, these banks are failing, I better get my money out of the bank before it fails. And the banks, as we know, banks don't keep all the funds in the bank. Banks are kind of a funky institution when you think about it. I mean, a bank is set up, and we'll look at the balance sheet, right? And we'll get to this in more detail. But banks are set up where they get their money in from demand deposits, right? People put their deposits in. And then what they do is they lend it out, hopefully in the neighborhood and stuff, and they get this money in, and demand deposit means you can come in at any time and demand all your money out. And they take this money and they keep a little bit of it for the people that want to take some out and do their day-to-day business. But the bulk of it, they lend into the community or wherever, and they might lend it to home mortgages, 30-year mortgages, right? Or they might lend it in 5-year loans to the baker and the carpenter and all this kind of stuff. And so you have, what you want to do is match maturities, right? And here you don't match maturities at all. These funds can all go away at any time, and these funds are locked up for 5 years or 30 years or something. So that's the problem. So if there's a run on the bank, once these funds go out, these funds don't exist. The bank is out of money, and so it has to close too. It's not solvent. So they've tried to do things where, now we have this system where we have the Federal Reserve. It will be a lender of last resort to inject capital into banks that are running out of money so that they don't completely run out, so people don't get scared. And we also have FDIC, the Federal Deposit Insurance Corporation, that insures these deposits to say, don't worry, it used to be $100,000. You've got up to $100,000 in this bank. If the bank forecloses, you'll get your $100,000 from the government. Now they've raised that to, I think, $250,000. But those are ways they've tried to shore up the banking system since the banking system froze up in the 1930s. So 1929, stock market collapses, all the banks, fail, or most of them. Everybody's out of work, or most people, and the country is just completely collapsed, and the whole world, basically.
Was there a single precipitating factor?
No, it was just the market started trading down, and there was a panic, and everybody started to sell, and it's that supply and demand thing, right? As everybody tried to sell, there was no buyers anymore, and all the stocks, the prices went way down to where they could find buyers, and by then everybody had lost all their money, and the whole system just failed. And we really had what they call a laissez-faire system, where it's like pure capitalism, hands off. Government's not going to get involved. If people lose their money, caveat emptor, buyer beware. It's just all their fault. And that's fine in theory, but when the whole country just collapses and falls apart, and suddenly no one's working, and people are leaving Oklahoma and trying to go to California, and everybody's just hopping trains and going around, and that turns into political and social unrest too, and suddenly the government is really threatened to collapse too. It seemed like maybe capitalism had failed, and fascism and communism and these other forms of socialism of government at that time that were experiments like in Russia and in Germany and Italy and all these other places started to seemed appealing. Like, these are the ways that things can work. This, free market, capitalism, and democracy, liberal democracy is a formula that has failed. That's really what it looked like in the 30s. It was really bad. So one of the things that when Franklin Roosevelt came in, one of the big things they had to do is reinstill confidence in the public markets, because that's where it's like crowdfunding, basically. It's a crowdfunding thing, right? Everybody puts their money in the markets, and then the markets allocate that money to the best projects, and then those projects get done, and that creates prosperity, basically. And that's how economic development happens. And that's been a beautiful mechanism when it worked. It really functioned well. Stock equity markets and bond markets, along with the corporate structure, that was a magic formula for incredible prosperity. But it was really tested in that time. And so they formed the Securities and Exchange Commission, and now all the companies who are going to be on the stock market, if you wanted to be on the stock market, you had to report financials in this way in a document called a 10K. It's still called that, a 10K. And we'll look at some of those. We can find them all online at the sec.gov. For every company has to do it every year with audited financials, and then every quarter they have to file what's called a 10Q, which is a mini 10K, just financials and an update, so that usually companies do 3 10Qs and then roll the last 10Q into the 10K, right?
This is just for public companies.
Just for public companies, right. But we can look at those and look at the reporting and all, and see it's very rigorous. It got more rigorous after the financial crisis, and actually even before that, there was this whole what they call Sarbanes-Oxley. That's a senator and a congressperson. That's how they name these bills, and did a financial regulation where they put more regulations onto these, like the CFO and the CEO actually have to sign the documents and say, we did these honestly, where they didn't have to do that before, like 2006, so they could get away if everything failed. They weren't on the hook. Now they are, and believe me, I've done these documents for a long time, and so you're liable for if they find any hanky-panky, you can go to jail or be fined incredible amounts of money and stuff. So it made it more, actually tried to put some responsibility where the risks could be. Otherwise, there's this thing called, I can't think of the name of it now, but it's where risk gets offloaded, moral hazard. Moral hazard is a phrase where risk gets offloaded and the person doing the deal doesn't care about the quality of the deal because the risk is getting offloaded. That's what happened with the last mortgage crisis, basically. It's like mortgage lenders were just making the mortgages and then selling them to Wall Street firms, which would bundle them into big bundles of thousands of mortgages and then slice and dice them and then sell shares of those, securitize those mortgages. So the people that were underwriting the mortgages didn't care anymore. It wasn't like back in the day where I'm giving a loan to this person for their house. I want to make sure they can repay it because it's going to sit in my bank vault for this amount of years. That didn't happen anymore. They just wrote it, took a commission, and sold it. And so there was no responsibility for the risk. So that's one thing Sarbanes-Oxley was trying to do to get to help with this. So yeah, so the companies have to report these financials, and companies have a vested interest just from the management side to make these good. Now there's also a lot of pressures on companies, especially public companies, to overstate some of these things to make their profits look better so that their stock price will go up, right? Or to keep the stock price up if there's problems. And there's ways that can happen. You think of these numbers as being objective, right? They're numbers, so they must be, written in stone. But a lot of these things are assumptions and estimates, and we'll talk about that. They're not really solid numbers. Some of them are hard numbers, and some of them are what they call soft numbers that are more estimates of value and things. Let's talk about, there's two kinds of accounting. There's what they call cash accounting and accrual accounting. Anybody ever heard those phrases? Accrual accounting, cash? Anybody know what the differences are? Good, because then I'll be telling you something novel. So cash accounting is where you just account for everything by cash. When the cash comes in, that's when you book a transaction, and when the cash goes out, that's when you say you've done an expense, right? That is a very, that's a simplistic way to do things, and it's not really that accurate, right? Because once you start really getting into business, you may have some revenues that you've actually delivered the good and the person hasn't paid you yet. Or the person has paid you in advance and you haven't delivered the service yet, right? Say if you're a baker, right, and somebody comes and says, next month I'm getting, 2 months from now I'm getting married and I want to have a great cake, so can you deliver it at that time? Yes, okay. And so, $100 comes in, and it comes in month, let's just put a couple of months up here. And the income statement is something that happens over time, right? And the balance sheet is a statement of something on a particular date. So the reason I did it this way, and I'll just start to fill this in a little bit, is usually bookend an income statement with two balance sheets, right? And we'll call this balance sheet the beginning of the year, and we'll call this balance sheet the end of the year. And the income statement is what happened during the year. Does that kind of make sense? And we'll get into it more. But this is something that happens over time, over, say, 12 months. And so you'd have a balance sheet at the beginning of the year, January 1st, say, and one at the end of the year, December 31st. And this is all the stuff that happened in between. So, in that case, you got $100 in month one, but you didn't make any cake yet or something like that. So then you would have, your profits would look like $100 a year. Wow, that's pretty good, And then come month three, when you make the cake, say the cake costs $70. Well, then all of a sudden you'll have minus 70 as your income. It's like, what the heck happened? Oh, well, that money's from there, right? So to make it less confusing, especially for outside people like investors and bankers and people that don't know about your business on a day-to-day basis, but just want to read these financials, there's a thing called the matching principle. Very important concept, right? And the matching principle is, what you want to do is you want to match up transactions. You want to match up revenues with expenses at the same time and call that a transaction. And usually what happens, you have some prepaids, but mostly what happens is you deliver a good and then you invoice someone and then they pay at a later time, right? Do you have that in your business? Chris, do you have like insurance or something where you'll do a session with somebody, and then you put in the insurance claim, and then maybe 6 months later you get half of what you thought you were going to get.
Yeah, I don't do that
No.
right now.
But you can imagine that kind of a scenario, right, in a business or something. So, and the thing that matches those up is what we call accounts receivable. Accounts receivable are revenues, right? They're revenues, but they're revenues that we really have that we haven't gotten the cash yet, but we have the bill is out or whatever, and the person's supposed to pay us. And sometimes not all the accounts receivable come in, right? Sometimes people don't pay what's owed. So sometimes you have bad receivables, or you have aging receivables that are 60 days old, 90 days old. So the concept of accrual accounting is really important, and we'll see why as we go through. But you can see that there's revenues. If you have revenues, and some of them are, you got paid right today for what you did, and some of them are, here's the cake, I'll invoice you, and in 60 days you'll pay me, or something like that, or 30 days. A lot of times there's terms, right, invoices like net 10 or net 30 kind of things, where if you pay within 30 days, it's that price, but if you pay after that, there's a little bit of an interest charge and all. So some of that is revenues are accounts receivable, money that we haven't actually gotten yet, right? So then we have our expenses too, and on the accrual side of things, we have expenses that we know that we've booked that expense. We have that expense, but we haven't actually paid it yet. Say something like an electric bill, or a bill from, somebody came in and did some refurbishments, or whatever it is, to your office space, and then you're going to pay them, and the bill's there. You put it into your accounting system, say, well, you have to pay this. The invoice came in, but we only cut checks maybe at the end of the month or whatever. And so, at some point, you'll have these payables that haven't been paid yet, right? These expenses that haven't been paid yet, and that's called accounts payable. So, accrual accounting, I'll put accrual over here, creates these other accounts, these accrued accounts, payables and receivables that aren't actually paid yet. And then when you pay it, then you take it out of cash and you take it out of the payable. And that's more of the accounting part of it. What we're just going to talk about are the financial statements for now, right?
John, how does it work if I've been doing some R&D and a lot of, it's all small beans right now, but eventually, let's say when we get a product or get a patent on it, let's say it's been 3 years since I've been saving receipts, and I've not been so good about keeping them, in an Excel or accounting sheet, but I have them.
Yep.
Can I do that? Like, let's say 3 years later?
Yeah.
It's not gonna be-
Yeah, those are expenses that you incurred. Yeah. And you could even be taking those expenses now. Do you have one of the things you could do is create a small company, an LLC,
I haven't done that yet.
and then you can actually and talk to your accountant. What you're going to need to do any of these things is get an accountant. And what you want to do is with those expenses is at some point you're going to have a corporate entity or some sort of entity, and that'll be your LLC. They're very simple to file. You file for like $25 go to the Secretary of State site, and you just go on there, fill out the paperwork, and I think it's $25. Pick a name. You go searching through the names, make sure that the name isn't already taken, and then you set it up. You take that to the bank. You make a bank account, and you keep everything in that bank account. So all of those expenses should flow through a bank account that's not your personal bank account.
And in that case too, if I've started the company after those expenses were incurred, is that going to be an
I think you can still use those expenses. You got the receipts and stuff. But if you're spending, even if it's $500 or $1,000 a year or something, you should probably make an LLC and then take those expenses on your tax return, because then that lowers your taxable income. And get an accountant that'll. Do you have an accountant that you work with?
I've got a guy
Well, and a financial advisor might be more on the investment side of, you should have life insurance and stocks and all that kind of stuff for retirement accounts. What you want is a business accountant that'll help you set up the LLC, or you can set it up yourself, and then start, taking those now. Those are legitimate expenses that you can take against your other income, or save them up and then take them all at one time when I think you can do all those kind of things. But you really need to talk to a pro to do that. And sooner rather than later is probably good, to find somebody. And there's a lot of good folks that'll do that kind of stuff, that do small businesses and help you out. Yeah, because that's important. All those are legitimate expenses towards your patent, and then the cost of filing the patent, all of the R&D expenses. Yep, they all go into, and they can be taken off of your personal income now, if you're the sole owner of that, or however. If you have a partner or something, then you share however the split is.
Presently, there's no income.
Yeah. So, but so then you can.
I'm gonna wait.
But you can take the expenses against your personal income.
Absolutely, yeah.
Or you can wait until it makes more sense, because you might be in a lower tax bracket and take them in 3 years. But in that case, I think you want to accrue them through a business, because that's what you want to do at some point, relatively shortly on, is not commingle your personal finances with your business finances. You want to have a separate business account at the bank. So there's these other expenses, right? And I'll talk about one more, just to really confuse you. When you buy a piece of equipment, say for that you're going to use for a company, say it was a pizza oven or a truck that you're going to use for delivery or something like that. When you buy something large that you're going to use over a number of years, that's going to add to your business, you don't want to just take the expense for that in 1 year, right? Because that's not really an accurate picture of how your business is operating. So say if you buy, let's just say pizza oven, right? And the pizza oven costs $10,000. And you buy it in this year here. If you expensed all of that money in this year, and say the company makes $5,000 a year, right? All of a sudden, you have like a negative $5,000 a year. And then in these years, you're going to have a plus $5,000 because you won't have any of that expense, right? A more accurate way to show what's going on with the business, but these years you're using that pizza oven, right? You're making your pizzas in it. A more accurate way would be to say, let's spread this cost over the useful life of that machine. And let's just say, to keep the math easy, the machine is going to last 5 years, right? So then how much would you allocate each year to that machine if you're going to say it has a useful life of 5 years? How much expense would you give each year to it then? If it's a $10,000 thing.
2,000.
Makes sense, right? So 2,000 times 5 is 10,000. That'll take the whole thing, and you'll allocate it each year for 5 years in a more meaningful way. That way, every year will look like $3,000 net income, right? And that's a more accurate picture because you're using it for 5 years, and then you're going to buy another one or whatever. And so you'd put this as an asset, and we'll talk about that. That goes on the balance sheet, right? And then each year you take what's called depreciation. It's called depreciation. And so each year you'd take depreciation on it. The first year you'd say, okay, it was worth $10,000. And in the first year, then your account would look like that minus $2,000. So the net would be, now it's worth $8,000 on my books. The next year, minus 2 would be 6, and and it would whittle down like that till it got down to 0.
Is
right?
there a formula for like various items, like for how much it depreciates? Like it's in the regulations you mentioned, the gap or something that's, like vehicles have a certain depreciation, and other things have a certain percentage that you go by, or you can't go over a certain amount or under a certain something.
Right, Josh. And that's one of the things where I'm saying that's more of a soft number. It's like an estimate. There's sort of some rules, but you can it's an estimate that you make. You might say, well, yeah, most people depreciate their trucks 15 years, but this truck is only really going to last 10 years, or there's accelerated depreciation schedules where you can accelerate the depreciation and take more in the first years and less in the last years. And depending on what your tax situation is and other things, you can change the depreciation to optimize your financial statements. So sometimes you might use a 3-year depreciation schedule, or a 5-year, or a 7-year. I think on buildings it's usually a 40-year. And so, that's what happens here. So you have this other charge now in these years, right? This depreciation charge, that's an expense now, right, that you're putting on here. But it's really a non-cash expense, right? Because you already paid all the cash. But now in year 3, you're taking $2,000 and $2,000 here. So you're kind of overstating your expenses from a cash position by $2,000, right? It's like, well, yeah, we said $2,000 and the net income is lower by $2,000, but that cash didn't really go out the door, right? Those are the kind of things that this thing reconciles, the cash flow statement. It takes all of those non-cash expenses and revenues that are over and understating your income statement, adds them back in so that you get an accurate picture of your cash. Does that make sense? That's really the real essence of this. And we'll go through this a few times, so it'll really start to sink in and make sense.
The cash flow doesn't include depreciation or anything.
The cash flow does include the depreciation. If you took $2,000 worth of depreciation here, down here you would say, I took $2,000 worth of depreciation, and it really didn't happen, so you'd add it back here.
Got it, yeah. Okay.
So this is where you counteract those things. Or you could say accounts receivable increased by $10,000, but we really didn't get it in. So down here that says, we're overstating our revenues by $10,000. Subtract out $10,000 down here in the cash flow statement. This is the trickiest part of it all, and it'll make sense after, we'll go through it a few times. So I'm going to erase this part here. So that's, and all of that stuff happens because we're doing accrual accounting, and we have these accounts that match up transactions and spread out expenses in a meaningful way that give a better picture of the business, but they're not cash. They impact cash in different ways. So that's why people say that profit and cash do not equal the same thing, right? You say, wow, I made a profit of $1 million this year. Well, maybe 500 grand of that is cash, or maybe 1.5 million of that is cash. You don't really know until you do all the add backs and all that kind of stuff. So we'll get into this statement a little bit more, a lot more, but I just wanted to give you a sort of an idea of it. And now let's talk about the balance sheet. Because basically what we're doing here is saying, okay, at the beginning of the year, we have a balance sheet that has our assets. And this is the way you usually write a balance sheet, right? The assets are on this side. And then there's the two things that sort of finance the assets on the other side. And what are they called?
Equity and something else.
Equity and something else, yes. What's that other thing? Well,
Liabilities?
yeah, sometimes you call it debt. A lot of times they call it liabilities. And liabilities and debt are two sort of synonymous words too, right? Because you could have your debt to equity ratio, you might hear that. That's how much borrowing you have to how much equity you have, right? Or it's your liabilities and equity. So these two things equal each other. Just trying to get you a feeling for the synonyms, some of the stuff that you hear. Sometimes this is called an income statement, right? Sometimes you'll hear it called a P&L, a profit and loss statement. Same thing, just different vocabulary. And sometimes, you can get confused by the semantics of it. I don't want you to get that, it's all the same. So there's an accounting equation, right? They call this a balance sheet for a reason, right? these two sides have to balance, right? The assets have to equal the liabilities plus the equity. And the liabilities, you can think of it as debt. It's what you owe, right? It's what you borrowed or what you owe. And the equity is actually what you own, right? This is what the stockholders own. This is what the owners own. And we can think about this. We talked about it last time. This makes kind of intuitive sense, right? Because we do this every month with our checkbook, right? You deposit some money in there, and then you write the checks, and then you hope that there's a little bit left over, right? If your outflow is more than your inflow, then your upkeep is your downfall. Right? Just regular financial management, right? So we understand this. This doesn't make as much intuitive sense, right? The balance sheet. But if we talk about it as a house, then I think that's a metaphor that works to get an idea about it. So anybody that owns their house or thinks about it, right? There's the house, right? There's three parts to it, right? The asset is the actual physical house, right? And the value of the asset, again, is an estimate, right? This is a soft number. And this number is derived from an appraisal. And how is an appraisal done? They look at comparable sales that have happened relatively recently, right? So you get an idea of what the market is. But no two houses are exactly the same, right? So then they start to make adjustments for, well, that house had 3 bathrooms, your house has 2 bathrooms, that house had 2 bedrooms, your house has 3 bedrooms, all that kind of stuff, and comes up with some sort of number for the house. And they also look at replacement cost. If it burnt down or washed away, what would be the price of all the materials and the labor to reconstruct it, right? So that's another way that they look at for the appraisal. So they look at market value and they look at replacement value. And then they do all these adjustments and stuff and they come up with a number, right? Anybody ever look at Zillow? Anybody into that? Yeah, Zillow's what?
Of course.
All the time, right? Yeah. Oh, I mean, it's really neat to look at. It's a great site where they have taken all of these different comparables and prices, and their whole thing is to put a valuation on every house on the map. And it's all done by, they just aggregate up the computer data and can give you a price. Now, some of them are more accurate than others. It's not that accurate here in New Mexico because the sales data isn't public information, which is kind of crazy. Yeah, so they don't have as really good accurate data here. But that's how they do Zillow can, and they also have listings and rental listings and all that kind of stuff. So houses that are for sale, but they'll give you an appraisal value too. So that's the asset side. And then on the right-hand side of the balance sheet is the debt or the liability is what? The mortgage, right? You have a mortgage. And the mortgage is what you buy the house with, right? This is what funds the house. It's the mortgage in this case and the equity. And the equity is, we call it the down payment. And then as the price varies and the mortgage goes down as you pay that off, the equity changes, and that's called your homeowner's equity, right? So this is how a house looks. So if the house is worth $150,000 and you had a $100,000 mortgage, then you'd have $50,000 in equity, right? And with a traditional mortgage, right, how much do you usually put down? What is the down payment, the equity that you have to put, that the bank wants to have you have, just at day one, 0?
20%?
20%, yeah, 20%. So that's considered, a reasonable loan. And so that would be a debt to equity ratio, of depending on how you did, 80% or 20% as you looked at it. 80% debt, 20% equity.
So
Yes,
the
Rana.
balance sheet have the interest somewhere, or does it include the interest rate
in the notes, it would say what the terms were. And so in this case, in a simple balance sheet like this, yeah, you'd have it. It's a 30-year loan with 10% interest or whatever. And then if it's with, say, if it was with a company, you'd have long-term debt, and you'd have lots of them. You know, you look at a company, it'd be like a 5-year, convertible note with 12% interest rate, and terms, and there's all these crazy terms with that. So you'd have a lot of different ones, but it would be very similar. Yeah. So you'd show the terms on there, but it doesn't really. All it's showing at that date is what the balance is in dollars. So it would just be this number. And then the interest basically would be an interest expense that you pay, and it would show up in your income statement. So this is what this looks like during the year. And so let's just keep that kind of in mind. And so now we go through the whole year, right? And say we had our company, and we made, let's see, this is 150 and these kind of numbers here, the assets, and say that we made, we'll say it was 100,000, and we had expenses of 80,000. So how much did we make net income that year? $20,000, right? 20,000. So, and I'm just whatever numbers, right? But so now we made this number, and at the end of the year, we have to show that on an increased balance sheet, right? We made some money. So now we have the assets, and we have the liabilities, and we have the equity. Now, in a company, in GAAP, the way that we structure the assets is a special kind of way. You have to label them all, right? And what we do is we label them from most liquid to least liquid. And liquidity means how much like cash is it, right? Can you actually go out and spend it today? With a house isn't that liquid, right? You can't go and then today say, you know what? I don't want to use this house, but I have 50 grand in it. I'm going to go buy some. You have to sell the house, and then you'll get the money, and it might take 3 months, it might take 6 months, something like that, right? You can't. It's not like having 50 grand in the bank, right? It's not as liquid as 50 grand cash. You can't go out and buy a car with it tomorrow. So cash is the most liquid, right? And that goes up here. And then we have some more. I'll just list some of the assets in their. Oh, I'm sorry.
No, I didn't say.
Oh, no, you could say. In their liquid. So we have cash, and we also have marketable securities, right? That would be stuff like stocks and bonds. We have a little bit of our money in to get a little bit of a return while it's in the bank. But you can, get that out of your Charles Schwab account or your E-Trade account, and go buy stuff with it tomorrow, whatever. Then you have your accounts receivable, right? And that's the money that's coming in. They actually haven't gotten it yet, but it's kind of like cash, right? But it's not really cash. The cash actually is in the bank. The accounts receivable, and then you have your inventory, right? And inventory is a little less liquid. Inventory is, say, if you're making iPhones, you got a whole bunch of them in stock, or if you're making sweaters, all the sweaters that you have on the shelves at Walmart or whatever else, that's your inventory. And you want that inventory to turn pretty quickly, right? And you want to, because if you hold it too long, it may become obsolete, and then you can't sell it, and then it becomes worth less, right? And it may end up selling it to the dollar store. That's where the dollar store gets all their stuff, right? It's like stuff that other companies can't sell. And just like you go to places like in Africa and stuff, and you'll see SEC conference game, right? The team that didn't win, but they made all the shirts for that team so that if they did win, they would sell them at the end of the game. But when they didn't win, they go off to other places to be sold. So they got all these ones that were the ones that could have won, but the 50-50 chance.
Yeah, because like all those teams there, they've got their celebration already.
They're already, and when
All the
they
champagne, all the
Yeah.
hats, all the
exactly, so all that merch has to go somewhere at 10 cents on the dollar or 5 cents on the dollar or something.
Or did you hear about this story of Burberry where they burn their inventory if it is not sold out?
A lot of the high end fashion stores like Prada and Versace, Burberry, they destroy their inventory if it doesn't get sold because they don't want it to end up at Ross or TJ Maxx or these kind of secondary shops where it's like, oh wow, that's I can get that. They have a cachet that they're trying to maintain, and so for them they feel it's better to burn it or destroy it than to sell it at a discount and erode their brand. Yeah.
Right now they changed the policy, they're gonna reuse it or they're gonna just recycle it because there's like something about the environment. Because they used to burn these stuff.
Well, yeah. I mean, it's like such a wasteful way. It's a way that people could use those clothes. Yeah. So even if they gave it away to homeless shelters or to people in need, right? People could use those Burberry raincoats. They all look incredibly fashionable. But they'd have to do it in some way where they, didn't know it was. They'd clip out the labels or something. Who knows? It's just like there's sites where you can go and get a hotel room at a fancy hotel and pay less, but they won't tell you what hotel it is because then that would sort of erode the brand. So, but they want to get the money because they have the room there anyway. They might as well, or fill the airplane seat, those kind of things, at the last minute. So right, inventory is an interesting character. How you deal with it, and trying to keep it fresh and turning, and not. That's one thing when you're looking at a company. If you see the inventory starts to get bigger and bigger number, it's like, what's going on? They're not selling that stuff. Somehow they're going to have to deal with it at some point. H&M, right? H&M, the great Scandinavian retailer of clothes. There's one in the mall here, but they're stuck with $1 billion worth of back inventory they don't know what to do with. So they're saddled with a giant thing. They don't know how to convert that into new money. Maybe they just cut holes in the new jeans and then they'll sell them for twice as much or something. But they're having a problem, and it's an inventory problem. So you have all that. Then you have your equipment, right? And again, equipment gets more specialized, harder to sell. And then you have your what they call FF&E, your furniture, fixtures, and things like that. And these are all tangible, right? And then you have your intangible assets, like patents, things like that. All your intellectual property, copyrights, patents, all those kind of things. They have value, but they're not tangible, right? They're not like a machine that you can, take and move and stuff like that. But patents are incredibly valuable. And when you put your patents on your books, you can only do them at cost. So all the costs that you're accruing for this, that's why you want to save those, because they inflate the value of your asset, and that's what you want to do. You want to have your patent be as you used to be as expensive as possible. So you show all the costs in it. Used to be a time where you could actually say, I have this patent, and that patent is responsible for X amount of income, and if I bring all that income back to the present value, that's the value of my patent, $25 million, not the $200,000 I spent making it, And so it used to be when you could do that, but you can't do that anymore. You have to do it at cost and then depreciate it. So now we have all of these assets and how they're done. But really, they're the same as this, right? We're just valuing them at these numbers. And they're all done at the book value minus depreciation. So they tend to get understated over time, right? Because you're whittling down their price with depreciation, and so you have a book value that's much less than what actually maybe you could sell them for, especially if it's buildings and things. Say if you were a company and you bought like Time or ABC or something, and you bought a building on 6th Avenue, 40 years ago, and it's a 50-story building, and you bought it for $20 million, and you've taken 40 years of amortization. It's zero on your books, but even at the $20 million, now it's worth $200 million or something, you know. And so there's a difference between the market value and the book value of your assets. Another thing you have to be careful of. So we want to reflect this year's earnings, this year's profits, on a balance sheet that reflects that we had a good year, right? So the way that we do that is this net income number goes into equity, right? That's where we put it. And so equity has two components. Equity has the money that you put in originally. Say, in a case of a house, you put in $20,000, 20%, right? But with a company, you're earning money on it. So say that the investors, when they bought the stock, they put in $200,000. Well, let's match it up with these numbers, right? I'm sorry. So let's say that the equity was 50 grand, right? And this is when the company started. We're going to buy $150 worth of assets, $150,000. We're going to take a $100,000 bank loan, and we're going to put in 50 grand, and away we go starting this company. And this year we made 20 grand, and so our 50 grand, now we're going to add the 20 grand that we made this year to it, and now we have equity of 70,000. So this is called paid in capital, right? And this is called retained earnings. Right? So every year you have these retained earnings. And so those two together make up the new equity number. So you can kind of think of this income statement as it resides in the equity section of the balance sheet.
What was the first one?
They call it paid in capital, or sometimes APIC, additional paid in capital, but it's paid in capital. It's what you pay in originally, and then with retained earnings. So, these guys had a nice year, right? They invested 50 grand and they made 20 grand off of it. So they made not 50% return, but maybe 40% return. We could do the math, right? I'm not going to do it in my head, but they made a nice return on their money in this case. And now there's $70,000 worth of retained earnings. Now we have to balance that with this side, right? If this was still 100,000, right? Then this number here is 170. Now this number has to be 170. Before it was 150, right? So we have to figure out how to add 20 grand to this side as well. Right? And we have on here, now we've talked about equity, we've talked about the assets. Let's talk about liabilities for a quick minute, right? Liabilities can be broken down into two, and the same thing with the asset side. But liabilities are in two categories, two main categories. Current liabilities and long-term liabilities.
All right, John, just to go back, the 170 on the asset side, that's the 150 for the assets.
It's the 50 plus the 20 in the equity, the 70, right. And then the 100 grand debt that we had from before.
Okay.
You said current liability and long-term liability?
Current liabilities and long-term liabilities. Current liabilities are any liabilities that you have that are going to be due within the year. And long-term liabilities are like long-term debt, that kind of stuff that's out more than a year. So current liabilities will be stuff like the bills you got to pay right now, the electric bill, salaries, the current portion of the long-term debt, the stuff you have in that year, all that kind of stuff. So those are your current liabilities. And then you have your long-term liabilities, and those would be bonds or mortgages or loans that you took from investors or banks and things like that. So because we're doing accrual accounting, right, we have accounts receivable here. In the current liabilities, we have accounts payable. That's the stuff that we need to pay soon, but we haven't paid yet, so it hasn't hit our cash yet, right? And we have our depreciation that we took on our equipment, right? Minus depreciation, minus depreciation. Sometimes we call that amortization too. Same kind of, those are synonyms too to a degree, depreciation and amortization. And so we have all of these different accounts that are changing the balance sheet, and then we have this retained earnings here, right? So now let's talk about the cash flow statement. Does that make any questions? I mean, I'm sure you know. Did you get that book I gave you today too? Yeah, and that should help a little bit too. And there's some really good videos on accrual accounting that can get that really square with you on Khan Academy. If you.
Which book were you talking?
So basically, we have a balance sheet that tells where our status is. We go through the year, we make our money or we lose money, depending. And then we have a new balance sheet that reflects whether we had a profit or a loss, right? Now, the cash flow statement is what reconciles this other side here. I mean, we got to figure out how to get to 170 on this side, right? And so that's what the cash flow statement ultimately helps us do. So the cash flow statement, the top line of the cash flow statement is the bottom line of the income statement, right? So the cash flow statement starts with net income and then makes the adjustments to make that reflect cash. And it has three categories, but we're just going to talk about the first category right now, right? And that's operations. Now, operations are all of these things that are overstating and understating our cash number on the income statement, right? So in here, we're going to, we'll have add back, accounts receivable or subtract it. If accounts receivable went down, then we're going to add some. If accounts receivable went up, we're going to subtract. Same thing with accounts payable. Any depreciation expenses, we'll add those back in. We'll make all those kind of adjustments, right? And then we'll have cash from operations at the bottom of this line, right here, right? Then we have two other things in the cash flow statement. We have an operations section that does all that, reconciles all this stuff. And then we have an investment section and a financing section. And the investment section is where we talk about monies that we spent on new equipment, or say if we had a piece of equipment that we sold, we'd add that money into here, right? That money doesn't show up on here, right? Say if we bought a new pizza oven, you wouldn't have it come out of expenses, you'd have it come out, you'd capitalize it, it would become an asset, and you'd say that you spent the $10,000 here on this investment line. If, say, we had an old pizza oven and we sold it for $500, then we'd add $500 on this investment line. This is where all the investments and all our equipment and stuff, all our assets takes place in here, right? That's all the equipment stuff that changes. And I know this is a lot of information, and we'll go over this in detail a number of times, but I want you to get the big picture, and then we can start to fill in the parts that you forget or that don't make sense. And then the financing section is the same, right? If you get money from a loan from a bank, or if you get proceeds from, you sell some stock or whatever it is, that doesn't go up here in your sales, right? So it isn't reflected in your income statement. It gets reflected down here, You just did a new loan with the bank for 5 years for 50 grand. Well, that money would come in here, right? So this is where the financing comes in. Or if you paid off a loan, or if you bought back some stock, whatever it is, that would come in here. When you get done with all of these three sections, the add backs and subtractions, this number here is cash, right? So you go from net income with all of these payables and depreciation and receivables and all, and then you bring it down to a cash number by doing all these add backs, and then how much went out as investments and how much came in as financings.
So the operations you said is accounts receivable, accounts payable.
Depreciation.
yeah.
A couple other minor accounts, but those are pretty much the big one. Those are the biggies, you know. So this part up here is just making up for these two things here, the overstatements and understatements in revenues and expenses.
And then, sorry, the last part,
Yep.
how do you, with cash, how does that come out? You add or?
You got all these things you're adding back and then you have your cash from operations.
Right.
And then if you bought any equipment or sold any equipment, you'd make those things here, cash from investments. And then your financings, if you took any money in from loans or paid off a loan or had proceeds from stock or paid off stock, either liability or equity, influx or outflux would come in here. And then this gives you your cash number, right? This cash number then gets added to that cash number, just like this net income number gets added to here, retained earnings, right? And when you do that, these numbers balance. And one thing you have to do, one of the things for the accounting department that's always takes forever because you never get this right, it looks like, is that when you take this number, right, and then you add it to this number, your cash number from before, then you have to look at your bank statement and it has to reconcile to the penny, basically. I mean, you might have rounding error of a couple cents, but those numbers have to match. You know, this actually has to be really how much money is in your bank account. And every time you do this, usually the first time you're way off and then, oh no, where do we make a mistake? And you have to go back through and back through. So that's where the accounting department gets crazy. So that's how it works. That's how these are all interconnected and how the numbers flow through here in a seamless reporting fashion. And then again, you do it for the next year, right? Then this becomes the beginning of the year, do another income statement, another cash flow statement, and another end of year. And it just keeps going, right? And the retained earnings keep, hopefully if you make a profit every year, this number just keeps getting bigger and bigger and bigger. And you can see that in lots of companies. Do any of you have any investments in stocks or anything like that, or think about doing that? Or even think about companies. You could think about, I wonder what, you could look at McDonald's, you could look at Intel, you could look at Google, you could look at Facebook, and see these kind of numbers and this type of stuff. It's real interesting to look at their different 10Ks because then they talk also about they have to do a management's discussion and analysis of the business and risks in the business, all this other stuff. But they give you these financial statements and you can see how they're doing and how they were doing relative to last year and the year before that and all. And that's what Warren Buffett does, right, all day long, is just read these things and really get into them and find out what's a good company. That's what they call value investing. You actually go through and look at this thing. The other way to do investing is just, on tips it up. Somebody said it's going to go up. And,
There must be a lot of tricks of the trade as far as overvaluing your company, or is it?
Absolutely. There's lots of tricks where, CFOs and, everybody's under pressure. This chief financial officer is the guy in charge of this, is under pressure to try to make these numbers look as good as possible so that, especially with public companies, say, wow, they're doing really good. And then the stock price goes up or prop the stock price up. A lot of times they bend the rules or go over the rules, sometimes by booking revenues too early, like maybe just when the contract was signed, not when the actual service was delivered. Really think about it. You could conceivably book revenues just when there's a handshake deal, when the service or product was delivered, when the invoice was sent, when the bill was paid. And usually what we do it is when the service was delivered and then the invoice sent and bill was sent. That's the accounts receivable end of it. Yeah, you can book it as revenue, but a lot of times companies will book it early so they can inflate these numbers, or they maybe understate their expenses so the net income number looks bigger, all kinds. Or do stuff that's off balance sheet with debt so it doesn't show up as debt on their balance sheet and it looks like it has more equity. I mean, you can look at, read books about Enron or WorldCom or all these companies that have done, these kind of tricks. And every time a bunch of companies figure out ways to do tricks, then they come along with Sarbanes-Oxley or some sort of, Frank Dodd, try to remediate and legislate to try to shore up the rules. So the rules, when they first made the SEC, right, the whole idea was to bring back confidence in the stock market because everybody thought it's a rigged game, just like today, right? All this stuff is insider trading. All this stuff is You know, you look at IPOs, the IPO price is $80, and the first day it goes up to $124. You know, who made all that money? Who left all that money on the table? The company didn't get it, the investment bankers did, and their cronies. So all that kind of stuff that happens, so people think that it's a rigged playing field. Keeping investor confidence in the markets is the crucial thing to keep the financial system working. So they wanted to try to really bring back trust to the market so that people would put their money in and feel that it was safe and they actually had a fair shot. And these numbers weren't, you know, we could look at these numbers and trust them and all that. So when they went, you know, Roosevelt wanted to get a guy that really understood all the ins and outs. He wanted to get the best, it takes a thief, right? The best crook that had, you know, done all of the shenanigans and frauds and everything, and have him run the SEC so he could, you know, shore up all that stuff. And do you know who he got? Joe Kennedy. John Kennedy's dad was like a great stock manipulator back in the day. And so he did his patriotic duty and, you know, showed all the tricks, or some of them, you know, that kept probably some in his back pocket, but, you know, so that they could regulate it right and bring back confidence into the market. But really, it's a tough deal. You know, there's always, the money is on the side of the people that are figuring out how to manipulate the markets and how to cook the books or whatever, right? And to stay one step ahead of the regulators. So there's lots of smart people trying to figure that out. And so the regulators are always a little bit behind the curve, it seems. You know, it's hard to, it's like whack-a-mole, right? You figure out this way and they figure out another way. And you're just trying to always solve how to do that. But this is basically, this is actually, you know, how it happens. And we can look at some real cases, and we'll go through this again though, so you just understand. But this is, I wanted to give you the big picture, because this is what it is. And it takes a while to go through the big picture because there's a number of different concepts that you have to kind of think about. But yeah, accrual accounting, there's a couple of videos by Sal Khan, you know, Khan Academy. Ever hear that online? And if you just put in accrual accounting, you know, Khan Academy, it's like a maybe 2 or 3 video sequence and like 2-3 minutes each. And he basically goes through and does that kind of timing and shows you why cash accounting just doesn't work. You know, I did it sort of a shorthand way, but he can, you know, it's a thorough explanation of it. But a lot of times people say, do you do cash accounting or accrual accounting? I remember at first I was like, oh, I don't know, what does that even mean? But really, everybody does accrual accounting. No one, cash accounting is, you know, meaningless. It doesn't really, you know, work.
Is it the same accounting that non-profit organization use, or entirely different?
Well, you also do accrual accounting, though. It's all accrual accounting.
There's no profit.
There's no what?
No profit.
No profit, but you have to show your revenues and expenses, and there's something on the bottom line. What happens as a profit is all of that goes into retained earnings, right? That's what happens. And the company just gets bigger. But you should look at your company's financial statements. Do you have a copy of them?
Not yet.
You should get a copy of them. Everybody who works for a company, I encourage you to get a copy of your financial statements.
But yours is a nonprofit, right?
It's non-profit.
But they still have to do these kind. They do. You actually do super reporting, because everybody that gives you a grant or something, you have to do this kind of reporting for. So sometimes a nonprofit might have 20 or 40 or 50 reports that they do like this for all the different grantees to show them, here's the money they gave us, here's how we spent it. And then you do an overall one for your board and all that kind of stuff too.
Kind of part of confidentiality, so they don't share it with all the staff except for the managers.
Right, you want to right, exactly. Like with public companies, all this stuff has to be public, but with private companies, that's proprietary information, so you're not supposed to share it with people. Yeah. So don't bring it and share it with us, but you should have it, and you should know it. I have a little test that I'll give you. I can send it to you, and it's a little spreadsheet, and it has a balance sheet, beginning of the year, end of the year, an income statement, cash flow statement, and then it has a bunch of yellowed, it's on Excel, yellowed squares, where all you have to do is do the adding and subtracting and get the other numbers, fill in the blanks kind of thing. And so first you do the first balance sheet, then you figure out the numbers for the income statement and the cash flow, and then you can figure out these. And the only number that I give you is accounts receivable went up by $75 or something like that. And that's the only number you need, and you can figure out the whole thing. So I'll send that to you, and give that a shot, and that'll actually test what you know and what you don't know. And that's the best way to learn, because then you come in and say, you know what, I got through the first few numbers and then I didn't know what to do, or whatever, you know, and then we can sort of go through, and then it's like, oh, that's how it is. And,
Is that something that we could use as a template too for?
absolutely.
MBA ASAP. MBA ASAP.